Hey everyone, welcome to the newsletter for this weekend. This is recorded on Saturday actually, so this is March 13th. So I'm going to assume the market doesn't explode between here and Sunday, and we can assume that everything remains relevant. So what I want to run through today is we'll do our standard Glassnode dashboard. Then I want to talk about a few things. I really want to get a bit of a feel for the supply dynamics, and in particular, how old the different outputs are looking at. So we're going to look at the HODL waves, which is essentially how much of the supply is held by certain age brackets. And we're looking for two things, right? We're looking for when the old coins are spending, and we're also looking for when young-ish coins are starting to mature to become older coins. So we're looking for dormancy, things that are getting more mature, which is hodling, or we're looking for old hodlers, the 3-year, 2-year, 1-year holders. When are they starting to sell? And we're going to also use the spent output bands to look at that. So we'll go through our Glassnode dashboard. We'll look at those two HODL waves and spent output bands, which I think are pretty useful for understanding what's going on. And then I also want to take you on a bit of an exploration. So I went down the rabbit hole of a metric called Liveliness the last couple of days, part of my Glassnode ventures. And I actually found it to be a really, really powerful metric to, first of all, to wrap your head around, but it gave me a lot of insight, and I went a bit down the rabbit hole, started doing up some coding, and actually ended up coming up with a few new and unique metrics, which I posted in the on-chain channel. So I'll talk through the logic of those. So let's start with our general overview. So last time we looked at this on Wednesday, we started seeing this rally in the SOPR, which is essentially profits being taken as we rallied back towards 58K. So we've basically come up, tagged what was the previous all-time high, and we haven't quite broken it yet. But again, we started to see some of these profits both on the short term, and you can actually see this spike here. So we got a single day where somebody or some group of the long-term holders actually sold into that rally. So it is possible that we could consolidate here for a little bit. Again, this is somewhat what I would call an isolated incident. So short term is still selling a little bit, which is fine. The long term, because it's basically rallied, so let's actually zoom in nice and tight. You can see that it was basically one day where it spiked at the peak and then pulled back. So you could argue and say that maybe there's a technical resistance up there, so it makes sense for it to pull back. You could also argue that maybe there was enough supply that actually got spent and essentially became that sell pressure. There's probably a bit of column A and column B. But obviously there was some event that was quite discrete, because this correction back to the downside of the long-term SOPR suggests that we're not seeing a whole bunch of old-term holders start selling. This is kind of, a handful. It was a single day event, could very well be a single entity. Now, if we then look at our time metric, so this is looking at the average. So on the left here, we've got the ASOL. So the average spent output lifespan. So that's how old was it on a UTXO basis. ASOL doesn't care about how many coins moved. All it cares about is the age of the UTXO, right? So it's a per transaction age, whereas coin days destroyed is a per coin metric. So coin days destroyed is age per coin, or actually, sorry, dormancy is age per coin, but coin days destroyed is arguably an equivalent to that. ASOL is on a per transaction basis. Now, what we can see is that we did not get a huge increase in the average age. Now, if this spike here, this long-term holder, if this was generated by lots and lots of people all selling at the same time, lots of old hands, you would expect the average age to be fairly high. Lots and lots of transactions that are all old, going to lift the average age per transaction. What we're seeing here is a very, very small increase in the average age, and that's telling me that a very small number of UTXOs that were old were moved. So that's where it's actually quite interesting. The more I've been looking into these lifespan metrics, you can use them for different, very, very nuanced things to understand what's going on. So ASOL is on a per transaction basis. We can see that we really didn't lift the average age of transactions, UTXOs, and that tells me it's probably a localized or a more discrete selling pressure. If we look at coin days destroyed, fairly similar, right? We're not seeing a huge uptick. So this is saying that, yes, we got an increase in the number of coin days that were destroyed, but we're not seeing something that's like, this is a sustained spike. This is lots of people liquidating old coins. This is a little bit of tentative selling. This is basically, to be honest, this looks like it wants to resolve to the downside. So I'm not seeing a huge rush for the exits from old holders here. So overall, I think this is a consolidation. I don't think that this is going to set some kind of lower high. That's just not what we're seeing yet, at least from the smart money. And you can see that on our binary coin days destroyed, let's zoom right in. This is on a 7-day moving average. And we're currently sitting down here about 0.6, 0.57. which is roughly saying that over 7 days, what's 60% of that? 3.5, 4 days. 4 days, 4 out of 7 have been above average selling. So we're not seeing this like sustain, like up here where we've got consistent ones. This is saying that for 7 days straight, we had coin days destroyed more than the average. As it dips down, we've got less than average. So this is telling us, that, and this is really confirming that we're not seeing a huge bum rush for the exit. So overall, I'm expecting consolidation, not local top, right? So that's that's probably the take-home message from all of this. Now, liveliness, I might just skip this chart because I'll come back to it because I think it's we'll go through that in a lot more detail shortly. Now, dormancy is very similar to ASOL, except it's on a per unit coin basis. So this is saying, let's look at all of the coins that moved, how many coin days were destroyed, and then of that, how much volume was moving, right? How many BTC were moving, and you take the ratio of those two. So what the dormancy is telling you, so ASOL is the average age per transaction. Dormancy is the average age per 1 BTC, per unit of coin. So it's kind of normalized to a different basis. And you can see here that we basically got a significant uptick on dormancy that we just didn't see on a per transaction basis. So what this is telling us is that it was more likely a single transaction that just so happened to be large enough that it increased the average age per coin. So this looks to me like a single entity selling a fairly sizable chunk that obviously put in some kind of local top. So that's what this is telling me. And it's probably the one thing that you can probably take away from this section is you can use these things to look at a per transaction, per coin, and actually understand the magnitude. Are we seeing a huge rush of long-term holders to the exits, or are we seeing an individual who just happens to be cashing out? My read on all of this, it was more or less a single individual or, one or two entities, something like that, that was essentially cashing out, not something that I would be overly terrified about, right? It's not a change in trend. This is someone who's paying himself. You can see that our exchange balance just continues unabated, right? That continues. Minor selling is it's still there, but it's very, very minor, so that's decreasing over time. And again, miners are less and less of a selling force in today's market. On our derivatives, we're back at all-time high. So of all the things to probably watch out for, this is probably it. Maybe we get a flush down of leverage. Maybe that's just a beautiful little lower high, something like that. This is probably the biggest threat, although we're seeing that our funding rate's kind of dipping down again. So, we're seeing speculation come back in, but it's not necessarily implode the world. But I would certainly be conscious. And what's this purple and pink? Binance and OKX. So Binance, I think I saw a tweet from CZ or from Binance itself saying that something like, I think it was like 25% of their traders use 125x leverage. So, we're talking about real punters here, right? We're not talking about smart money. We're talking about gambling. So, if this was to flush out, it's not going to be a systemic problem. It's going to be a let's nuke some serious noobs that take their money and then rally north. The grayscale premium is very interesting. So there's been a few people talking about it. It's currently traded at a discount for over a week now. The grayscale premium, why we have a discount here, I think is a few different layers. One, we've obviously got a correction, which is going to be reduced interest. Two, I think institutions are not used to seeing a chart do this and still be, doing what it does, right? Bitcoin is clearly a chart that is not normal in traditional finance. And I think they're still probably adjusting to it. So they're probably a little bit wary of what's going on, which again, I'm going to probably say a longer term consolidation up here would not upset me in any way, shape or form. It's starting to look like maybe that's the case. It could very well happen. There's clearly the demand has waned a little bit. There's also a few competitors. There's the Purpose ETF and there's a few other ETFs that are starting to come out in different jurisdictions. So there's more competition as well. It's quite a complex thing. And I know there's a lot of lending and other layers to this grayscale premium. I don't think it's something that people should be going, oh my God, it's the complete opposite of the bullishness of a premium. The discount's horrible. I think this is just the market working out itself, particularly during a consolidation. And institutions are still relatively new to this game. So it's not something that's concerning me at this point in time. And I will do a bit more reading to understand a little bit more about the mechanics of that particular metric. And then if we look just finally, just to close out here, you can see, our liquid supply chain. So this is more or less mapping back up to our exchange balance, which just keeps trending down. You can see that this red here is basically coins going from liquid state, moving around to illiquid state. And you can see it just continues, right? So we're talking about 135,000 BTC transitioning from being liquid to illiquid. I mean, it is truly remarkable what is going on that front. So we're still seeing accumulation. We're seeing accumulation that we've just not seen. And actually, let's just quickly let's boot this guy up. And then our hodler net position change, similar to the miners, right? You can see here that we're still on this downtrend. The peak is nowhere near what it was at 42,000. I actually think there's more confidence up here than there was back here, because this is the first major rally from all-time high. People are going, oh, maybe this thing's going to collapse back down to 20. I actually think that the confidence is higher because this is just not increasing at the same rate. And you can actually see here, I think this is an important chart. So this is our liquid supply change. I don't have a drawing tool, unfortunately. This trend, I mean, just you could draw a beautiful trend line through here. It is increasing, and this started, I mean, essentially, that started back in the consolidation, right? So ever since we were back in just before April 2019, we've essentially had accumulation going on and a decrease in the green. So the green is coins doing the opposite, coming from a illiquid state to a liquid state. And you can actually see we've got the trend down here and the trend up here. And if you actually look at this on a bird's eye view, that right-hand portion of the chart looks nothing like anything else. Everything else has been an oscillator up and down. You get supply coming in, out. That one on the right-hand side is just so unique. And really, this is our starting point right here, right? March 5th. So before the rally north, that's really where things started to play on. And again, if you went hard right edge, this just looks like anything else, but it's this growth in supply coming out. And you can see that since March 12th, that's where we've really had the expansion. So I am sitting here at 65, 75%. This time is different. That is kind of where my probabilities are sitting at this point in time. So pretty remarkable stuff. Okay, so now let's jump into part 2 of this thing. We're going to look at our hodl waves and our spent output lifespans. Now, we're looking for 2 different elements here. We're looking for, are young coins now maturing? Are we getting people starting to hodl again? And we're looking at old coins being spent. So they're the 2 sides of the equation that we care about. How much more hodling is coming in, which is young coins becoming old coins, and when are coins that are old getting spent back into circulation. Now, the cutoff point that Glassnode uses is 155 days for that short-term, long-term holder. And this is actually a pretty good level. It's about 6 months, so let's just use 6 months as our kind of cutoff point. When you look at a probability perspective, any coin that's been dormant for 6 months, the probability of it being spent is just dramatically lower. So it really is the point when coins become less likely to move once they've aged beyond 6 months. So what we've got turned on here is our young coin setup. So on the right-hand side, we've got percentage of global supply, circulating supply. We've shrunk it down to, this is basically just our young coin metrics. And as you would imagine, when we come to the end of a bull market, you're going to get a lot more old coins going from a 3-year-old coin to a 24-hour old coin, right? They're going to get spent and they're going to reset their lifespan back to 0, and they're therefore going to be back in circulation. That's what we care about in this particular instance. Now, in our previous cycle, you can see that we had this kind of, let's call this our, I mean, this is obviously our bear market. This is our disbelief phase, where you get a few people who literally couldn't believe it, so they started spending into that. You get this hump here. Then we get this, oh, hang on a second. We're coming up to all-time high. There's a little bit of confidence returning to the market. And then we get the first section here, which is break above all-time high. This is kind of our 42,000 rally. This is people going, all right, I'm going to scale out along the way, right? Scaling out. You can actually see this is increasing over time. Then once we break this first major dip and we start getting pretty parabolic, this is where you actually start seeing coins really start to increase. And importantly here, so our 24-hour, we can kind of ignore. What we care about, what's this orange here? 1 week to 1 month. This is relatively new coins, right? So these are coins that were bought a month ago, really spiking. That's people who bought this dip here, right? This dip here start aging to be a month, and then they start spending. So when these spikes here are actually moving down, this is young coins that were bought a month ago, selling and taking profits. And ultimately, that's starting to look a little bit like, you know, retail get in, they hop in, they trade, they move around. It's starting to get frothy, right? Coins start moving. They're not really going from young coins to hodled. Once you get into this real peak phase here, these are essentially where people are trading, right? We're starting to move into the day trader realm. The volatility is there. The momentum traders are there. Coins are moving between exchange. There's all that kind of stuff going on. So that's really what this final euphoria phase looks like, where you're getting this Increase in young coins, sell off in young coins. Increase in young coins, sell off in young coins. It's essentially the same people mincing the same coins around. It's starting to look a bit like froth. But also the magnitude, right? You can see that the overall height of these less than 6-month-old coins relative to back here, right? When all this white space are older than 6 months. So the more white space we have on this page, the more coins are maturing and getting older. The less white space we have, the more those old coins have been spent back into circulation. So not only do we have the dynamics of froth internally within these young coins, we've also got old coins going from, let's just say at this point here, what's our grid line? This is 30% of supply, and up here we're talking about 50%. So an additional 20% of Bitcoin supply has been spent by old hands back into circulation over this period of time. So where we are at the moment, I mean, I would almost argue that we're somewhere in this realm, right? Which again lines up with this chart. So, you know, we're starting to see this first peak. Maybe we're sitting somewhere around here. I mean, that would give us the second correction, which again is pretty much exactly where we are right now. So, I mean, we're certainly getting to a point where it's time to start thinking about what a top could look like. We're starting to get into those same fractals and same patterns. My instinct tells me that 100K is going to be A, hit, and B, probably an area of key resistance, right? Maybe we rally to 100K and then drop back down to 75K or 60K or something like that, right? Something that really just gives everyone that real fright. Maybe we get a fairly extended long correction from that. It would make sense, to be honest. And there's some pretty spectacular gains coming off that. What would that be? That's a 5x off all-time high. So, and just a psychological number. The whole thing just kind of makes sense. So, how you're going to trade that is probably, you know, within your realm, but it's certainly something to start thinking about, because we're getting into this. You know, we're on one of these peaks if we think that the previous cycle is there. But again, we're still seeing those coins come off exchange and move out of illiquid to liquid state, right? So we're starting to see. Maybe it's different. We're still going to get technical analysis. We're still going to get corrections. There's still supply coming in. So I don't think we're ever going to see 20,000 again, right? I don't think it's going to be a blow off top. It's going to be an 80% drawdown. I do think that the dip will be bought, and it will be bought in size. And I think it will be less volatile. It could take longer than people expect. Time could be the pain trade here. But that's overall what I'm seeing. So our global supply here is something around 35% or thereabouts. Previously up here, we peaked at 50%. We peaked here at 50%, roughly 50%. So, you know, we've still got some time left in this market if these fractals, you know, essentially play out the same. We could also peak a little bit earlier because more people are going to hold. So I would almost argue that the height of this peak is probably pretty important to watch, because it's going to show how strong that hodling demand really is. The more white space we have, the more hodling demand is in play. And if we look at our spent output age band, so this is saying on every single day that we want to look at, what was the age of the transactions that were spent. So what I've gone in here is the dark colors. The darker the color, the older the coin. So when you have a 10-year coin, let's just hover over, let's go let's go a bit more juice. Here we are, 2 to 3. So this line chart that you can see here, these are the coins that were spent that were 2 to 3 years old. Now, if we look at this in terms of fractals, you can see that during the final blow-off rally here, we had a lot of spiking. We had spikes through here. We had spikes as we came out of the consolidation, out of the first bear market. We had spikes as we came out of the second market. So this is what we were saying before, right? Here's your disbelief. People going, I can't believe it. Like, I'm getting my money back, right? Then we start to get people who are going, okay, we're at all-time high. I'm going to start taking profits on the rally up. We get a little bit more, oh, hang on a second, this thing's really running, right? I'm going to hang on to it. Now it's starting to get frothy, right? You get your first major correction. People think, oh, the top is in. Then you get it quietening off again. This quietening off is good. Then you get the blow off top. Interestingly, this is actually showing us, right? Let's go with the all-time high right here, the 20,000 all-time high. Look how low the bands are relative. This here, people did not realize that this was all over. People thought it was one of these corrections until we had that massive sell-off down to 6,000, and then this rally back up to 10,000. This is where people recognize that it was game over. So I would almost argue that 20,000 top surprised everybody, right? And I guess that shows how euphoric the market really was. People didn't actually realize it. Even the long-term holders didn't realize that was in play. and they really sold on that 10,000 lower high. So, you know, pretty powerful tool when you actually look at it from that framework. You can see that there was obviously a bit more, particularly around this capitulation event. I mean, look at this. That capitulation event down to 3,000, that scared a lot of people. All of these coins, what we got here? 3 to 5 years, right? So people who have held since, when was this? That was end of 2018. What's that? 3 to 5 years. So we're talking about people who were basically accumulating through this bear. They were the ones who were actually capitulating through here. And man, that would have hurt. Especially after seeing all of this play out, right? You had plenty of opportunity to get out 10,000 or even 6,000. Now, where we are at the moment, you can actually see that, yes, we had that first 40,000. So we've spoken quite a bit about the 40,000. We saw it in all our time-based metrics, old coins coming back to life. So we definitely got the sell-off here in that 42,000. But you can see it's actually quietened down. Yes, we've still got some liquidations going on, but we're really not talking about huge amounts of supply, especially relative to all of these. It's actually fairly tame. So this is really telling me we have a lot of people hanging on, right? Hanging on to their coins. Again, I really do think that we have a this time is different in play. That's not to say that we're not going to get our corrections and we're not going to get our volatility and all the rest of it, but it's certainly saying that the HODL strength is quite unique in this market setting, and ultimately, you know, our March 12th sell-off was the trigger point, right? That's when things really started to heat up, and essentially the market and the Bitcoin market changed forever. So overall, I think this is a nice, healthy consolidation. I'd like to see it chop around a bit more, maybe flush out some of that leverage. But overall, you know, it's pretty hard to be a perma bear at this point in time. There's very few bear cases I can find on chain. It's a very orderly and structured market. There's clearly strong demand coming in, and the supply just keeps getting sucked off exchange. So at the moment, no reason to panic. Certainly start thinking about that 100K level as a possibility. But that's the overall assessment. Now, liveliness. Let's touch on this because I think it's an interesting metric. Now, what liveliness is, I think maybe we just look at the equation here. So every single day, every coin that's in circulation will accumulate 1 coin day, right? So if we've got a supply of 18.5 million BTC, then they're assuming that they don't get destroyed, which they can't be, they're going to accumulate, on aggregate, 18.5 million coin days. 1 day per BTC, 18.5 million coin days. Now, some of those coins may be spent during that period of time. So let's say that you withdraw a coin, you know, 9 a.m. in the morning, and then you spend it 9 a.m. the next day. It's accumulated 1 coin day, you've spent it, and then it starts reaccumulating, right? It's still accumulated 1 coin day. Now, if you bought it at 9 a.m. and you sold it at 9 p.m., and then you sold it again at 9 a.m., you've spent it twice. So you accumulated half a coin day, then you spent it, right? And it reset, and then it accumulated the second half coin day. So at all times, every single day, the entire network will accumulate the circulating supply worth of coin days. So what liveliness is doing is it's looking at, over time, how many coin days have been accumulated by the entire network. So this is essentially a cumulative sum, right? You start with 50 coins, or you know, 50 times 140 blocks. The first day that Satoshi did it, right? You've got whatever number of coins that is, then you've got that plus what was mined the next day, then you've got that plus what was mined the next day. So every single day, you add the supply. Just add the supply every single day, and that's obviously growing each day. So that's saying how much global time, essentially, per coin has accumulated in the network. What we then do is we look at, okay, how much of that was spent? Now, for a network where there's never been a single transaction, the miners have just mined the coins and they've never been spent, ever. Your liveliness will be 0 because you've got no coin days destroyed, but you're continuing to accumulate coin days. So it's essentially, it's 0. Now, if the whole supply, right, day 1, it accumulates, let's just say for argument's sake, 18.5 million coins. It accumulates 18.5 million coin days, and every single coin is spent once at the end of the day. You've also spent 18.5 million coin days, so you now have a liveliness of 1, means the entire supply was spent, and you've now got it's essentially saying the entire network was active. Now, we know that every day, every coin isn't spent. You get coins that sit dormant for a number of years, you get some coins that are lost. So liveliness is going to vary between 1, which is every coin is being spent every single day, and 0, which is that there's never been a transaction. And over time, the more coins that are moving in the system, the more often they're moving. So a very vibrant, active, adopted network like Bitcoin is going to have a relatively high liveliness. It means that yes, there's lots of coins being moved around, but it's also like it's always accumulating coin days overall. But if we've got a liveliness of 6.6, that means that 60% of all the lifespan has been moved. It means that there's stuff flowing through the system. So what is important? Let's jump to our chart here. When you've got lots of old coins being spent, you've got a lot more coin days being destroyed. In other words, a lot more lifespan is being spent. There's a lot more activity. You're going to get an increase in liveliness, right? Back down here, we had very quiet. There's not much going on back in Satoshi era. Here, in fact, this is almost the end of Satoshi era, 2011. But you can see we've got a liveliness of 0.15. That means that 15% of the global lifespan has been spent. As we get rallying, right, we get this price increase, this first major rally, a lot of the network comes back to life, and we actually rally up to almost 0.4. That's saying that we've got a significant amount of coins that were old and have now been spent. They're back into circulation. So increasing liveliness means old coins being spent. Liveliness that is high is good. It means that the network is active and vibrant. So you can use liveliness to compare Bitcoin and Litecoin, or Bitcoin and whatever other protocol you want to look at. Trending sideways essentially means that you've got the amount of supply. It basically means that every day, approximately, your supply is being spent. So it means that some old coins are coming back on, some young coins are being spent twice, right? Overall, it's kind of the growth of overall protocol life is matched by the amount of on-chain activity. So you can, and you obviously see this through bear markets, and you can almost see that this looks somewhat like the difficulty ribbon, right? Where you get these plateaus where it's, there's a little bit less interest, mining doesn't quite expand as much, then you get this expansion, similar to the realized price. In fact, very, very similar to the realized price. And I'm sure that if you plotted these over each other, you get a very similar behavior. Where it differs from the realized price, however, realized price will only downtrend when you've got coins being sold at a loss, so it's price sensitive. Liveliness, when you get a downtrend, it actually means that there's less activity, which means coins are becoming more dormant. So a downtrend in liveliness is actually a bullish sign. It means that coins are moving from active state into hodled state. And what you can see is that during these corrections, right, you get a downtrend. That means that the amount of coin days in the system is accumulating faster than the on-chain activity. There's more dormancy creeping into the system. Then you get a price rally, more of those old coins come back to life, you boost up your liveliness, and then you go into a period of consolidation, right? And then you start to rally back up again. So you can actually see that we're getting this hodling pattern. Then we start to get spending into the all-time high. Hodling pattern, and now we're starting to get that spend into the all-time high, right? So this gives you a bit of an idea about how liveliness works. It's kind of like the realized price, except you can spot hodler characteristics. Now, one tool that I've been playing with is building a liveliness ribbon. So you can use the Glassnode compare tool. I've just got on metric 1, I've just got price, axis 1 on log scale. Metric 2, I've got liveliness, no moving average, axis 2. Metric 3, liveliness again, 30-day moving average, axis 2. Metric 4, liveliness, 90-day moving average, axis 2. And you can see that when we get a ribbon expansion, it's essentially old hand selling. When you get ribbon contraction, it's coins being essentially accumulated, right? You've got dormancy building into the system. Old hand selling, dormancy, old hand selling, long period of dormancy, old hand selling, dormancy. You can see this spike up here. Let's really zoom into this guy. This here, right, the capitulation event. This is, remember we were looking at the spend output bands? These are old coins coming back to life en masse. That's why this spikes so heavily, right? So this is actually this is true capitulation. So for those of you who've been around for some time, I remember Doc saying that where the hell was the capitulation? The capitulation happened on chain. It didn't happen in terms of volume. We didn't get that same volume that we were hoping for. But man, when you actually look at the magnitude of this, it essentially reset all of the dormancy that was accumulated through this bear market, right, in one move. That was the capitulation event. This here was the capitulation that happened on chain, and we saw this in our spent output bands. There it is. that is our capitulation event. There's our capitulation volume because the old hands got burnt in this whole process. So, just a little interesting insight with all of this. And then you can see here, we went back into dormancy. Really a lot of coins being accumulated. I mean, you can see the downtrend here. These are coins that are getting pulled off, no longer circulating, right? So, and during this rally here, this would have actually been a good signal for us to have looked at to go, yeah, there's serious coins being accumulated here. As we break up towards, what was this, 15K, so breaking this previous all-time high, a few people got spooked, and you can see we've just started expanding again. So it's really supporting many of the metrics that we were looking at previously, and just understanding a bit more about what the old hands are doing. So just to close out the ribbon we just talked about, there's two things I was looking at. One was you saw how we had downtrends and uptrends, and as some of you know, I look at these gradients. How steep is that line? How steep is the ribbon, more or less? Now, the steeper it is, the higher these oscillators are going to be. These are essentially our gradient oscillators, but for liveliness. And you can see that during a bull market, right? Let's put our spike lines on. During a bull market, right? We start here. You get a continuous uptrend in the oscillator. During a bear market, you get a downtrend, right? This is dormancy. This is old hand selling. Dormancy, flat line, which means accumulation, right? This was our capitulation event. All of this was essentially accumulation, sideways action. Now we're back into the selling phase. And you can see that we haven't been here for that long. It's kind of similar to, looking like this here. So we're really not seeing the same amount of liveliness, the same amount of expansion of supply coming back on the network. So again, this is telling us we have a fairly strong hodling situation going on. Again, this time could very well be different. And just to finish off, this is another one called binary liveliness. So what I'm basically trying to look at here, and when you've got a signal or a color here, it's saying, was it higher? Was the amount of liveliness increased? The amount of coins that are being spent back into circulation? Was it higher than some reference baseline? So I've got a few different methods here, but in the purple, it's basically saying, did we get an increase in liveliness? Yes or no, 1 or 0. The blue is basically saying, is it higher than the previous 30 days? And if we actually turn everything off except that, you can basically see, again, spike lines, you can basically see, yes, we had more than 30, like if you look at the previous 30 days, yes, we had a lot more coins coming back to life through here. And through all of this period, happy days to accumulate, right? Very, very little relative to the previous 30 days. And then you get this block of selling. Back here, great to accumulate, block of selling, right? Great to accumulate, block of selling. That's really what this is trying to tell us. And you can see that we've basically kicked into our first phase from 14,000, yeah, thereabouts, 14, 15,000 for the previous, what was this, the plus token Ponzi high, block of selling. So overall, right, it is looking very much like our previous cycles. Maybe this block here is something like our first pump, right? Maybe we get this thing rally up to 100K, and that's our first kind of Willy Woo style double pump. But this is overall what it's telling us. And then this red one here is very much the same. It's looking at the previous 30 days, except this one's saying, is it higher than yesterday? And then taking an average over 30 days. A little bit of nuance, but you can see that essentially the peaks, the height of these peaks is telling us that same momentum, right? We've got increasing momentum of selling, and then we get this kind of equal high up here, which is saying, maybe we're starting to get into our second head. You can see here that we peaked on the red bar here at our 42,000, right? And we have not increased as hard, right? This red line here has not got up to the top level again, which again is supporting many of our metrics, our old hand metrics, time-based metrics. We're seeing less selling up here at 58K than we did at 42. There is more hodl demand going on at 58K than there is at 42,000. So that's starting to tell us where we're at in this market cycle. I would be wary of a longer term correction here. I would also be wary that the next pump could very well be a significant correction that follows. How you deal with that is probably in your court, but just consider that 100K is probably going to be both a possibility, but also pretty strong resistance if I was to hazard a guess. So there's a lot in that newsletter. Hopefully you get a little bit out of it. I'm still building out these liveliness tools, but overall I find it to be a really, really interesting, and I like the relevance to the realized price. I think it's a nice, and the difficulty ribbon, I think it's a nice little analogy, but it's basically the hodler version of the difficulty ribbon. So we can, I will build these into check on chain once they're fully developed, and that'll give you all access. So stay tuned for that. Thanks for tuning in, everyone, and I'll catch you in the chat rooms. Cheers.